NTSX is a really unique ETF that brings leverage to a 60/40 portfolio into an ETF wrapper. I'm going to take a look at how this fund works and also how it would have performed historically. So the official name of NTSX is the WisdomTree U.S. Efficient Core Fund. Now, the name is fundamentally meaningless. Interesting to note, it has been rated 5 stars by Morningstar, and the expense ratio on the fund, which I don't have open in front of me, is very low. I believe it's 0.2%. So for a unique, I don't want to say active, but a unique financial product, that's pretty low. And that's lower than a lot of the other ETFs that have leverage built into them, like, well, the common ones are SPXL and TMF, triple leverage S&P 500, and triple leverage long treasuries. Those both have about a 1% expense ratio on them. So a 0.2% expense ratio is incredibly low for this type of product. Right? So what does the WisdomTree U.S. Efficient Core Fund actually do and hold? Well, what it does is it levers a 60/40 portfolio of U.S. stocks and bonds, so basically S&P 500 and U.S. bonds, about an intermediate term duration, and it takes those and it levers them 50%, so that you effectively get 90/60 exposure to a 60/40 portfolio. Okay, so you're levering up a 60/40 portfolio 50%. So why 60/40? Why are we doing that? Well, here's the interesting thing, right? If we were to look at the risk-return ratio of a 60/40 portfolio, we would see that usually 60/40 portfolios historically have had the highest Sharpe ratio, the highest risk-adjusted return. So you're getting the most amount of upside for lowest amount of downside. So basically what they're doing is they're saying, hey, 60/40 has the best risk-return profile. Let's take that and then lever it up. Now, what NTSX does that is incredibly unique is rather than leveraging up the stock portion of it, rather than levering up the stock portion, they just overbuy in the stocks and then over-leverage the bonds. So what I'm saying is you don't get S&P 500 leveraged 50%. Rather, they take all of the capital and invest 90% of that in the stocks. Now you have 10% remaining, and then they lever that up 6-to-1 to get the exposure on the bonds. And they do this using futures. And we can see that if we come here to the WisdomTree holdings, you can see that their bond holdings are in futures. These are future contracts right here. So yeah, so they're levering up the bond portion using futures, and they're not levering up the stock portion. Now, why is that cool? Well, what happens here when you lever any product is you're subsequently, kind of subjected to decay when the levered products have to reset, unless they're holding loans and paying interest, which they're not. They're using futures. So you will have some decay with any type of levered product using futures. And that decay tends to be worse on products that are, or instruments that are highly volatile or more volatile. So it makes more sense to lever the bonds because they don't really have any volatility. They don't have any volatility, so they're not not subject to as much decay. There still can be decay from the leverage implemented in them, but it's not going to be as much. And mind you, they're not resetting these products daily like many of the levered ETFs do. So they're a lot less susceptible to decay than any other levered product out there. All right, so the big question is how does it perform? Well, one of the other things they're seeking to do is outperform an index of 100% stocks. And for that, I found this nice little backtest here that was ran in Portfolio Visualizer by Optimized Portfolio here. And they've synthetically created the NTSX going back to 1992, levering up a 60/40 portfolio. And what we can see is, number one, the final balance, the total return of $10,000 invested, becomes $306,526 over a straight S&P 500 of $184,939, compound annual growth rate at 12.27%. So it has done incredibly well, outperforming the S&P 500 using this strategy. And finally, you can see the Sharpe ratio at 0.8 versus 0.60. So it's doing 33% better in terms of risk-adjusted return as the Sharpe ratio measures it. And finally, the max drawdown historically would have been 39.26%. So, it's effectively it has done what they planned for it to do. And I guess that's kind of that kind of goes without saying. You never see a bad back test. But it is, historically, the strategy has outperformed the S&P 500 with a better risk-adjusted ratio, which is what it aims to do. And since going live, this is always cool, right? We want to look at out-of-sample data. Since going live here, I believe it has outperformed the S&P 500 as well. So we'll just set this to max. Let's put the S&P 500 on there. There's been no slouch in returns. The S&P 500, yeah, so going back to when this was launched at the end of Q3 2018 to now, the S&P 500 returning 74.21% or 74.22%, while NTSX has returned a little bit more with lower downside volatility, or lower drawdown and lower volatility here at two pieces. So I think that makes this a really interesting and a really viable ETF if you want to get some leverage in your portfolio. What do you guys think about NTSX, the WisdomTree U.S. Efficient Core Fund? Is it something you would add to your portfolio? Do you like it? Why or why not? Let me know in the comments below.